what you as managers need to always remember that accounting is a very good tool, but it's not the end all be all. And so there are some limitations associated with it. And what we have to be concerned about from the concept of management is that sometimes it may lead to a very short-term focus. In other words, we're so concerned about ROI, return on investment. You guys remember that? Return on investment is operating income divided by total assets. And I told you earlier, if you recall, you can go back and check, that we can have a high ROI two ways. We can have a lot of sales, a lot of income rather. We can have a lot of income, or our investment in assets can be low. That will give us a high ROI. And so what might that do? It could motivate managers to delay the purchase of new fixed assets, because they know that if they buy new fixed assets, it's going to immediately have a negative impact on their ROIs. Great for the short term. You can use older equipment and make your numbers look really good. But if you do that for an extended period of time and you don't reinvest in the business, then over the longer term, those machines do break down. And when they break down, it may hurt performance. And for the longer term, it may come back and bite you. Okay. The next concept that's discussed in the textbook is called transfer pricing. Specifically, transfer pricing is about a price that may be charged for the internal sale of products between two different divisions of the same company. So we talk about creating investment centers or profit centers, but to do that, we may even have to end up creating small little businesses within the business. In other words, a department, if you want to consider them to be a profit center, well, that profit center means it's going to generate revenues. And what it's going to actually do is it's internal, so you're not going to be selling to outside customers, but what it's going to be doing is selling its product to the next department or the next area or the next division. So that now you create an environment where everybody's motivated to act as if they're running a business, right? Looking to cover revenues, maximize the revenues, and minimize their expenses. So the question becomes, what should be the transfer price between two different divisions? When one division is actually completing a product, but they're exclusively selling to another division, then what should be the price? What should you charge the recipient, the receiving division, and what should the selling division earn, so to speak, or receive in terms of revenues? Okay, so when we're talking about two different divisions, becomes sales revenue for the selling division, the one that's actually generating the product, and becomes a cost to the buying division. Well, now we have competing priorities, because the buying division always wants the lowest price, and the selling division is always going to want, each of them are trying to maximize their profits within their specific divisions, right? So the transfer price is going to affect the operating income, the ROI, the sales margin, and the residual income of these divisions. And it gets a little tricky because, again, you have competing priorities between these managers, and they all want to watch out for themselves and make sure that their own numbers look pretty good. But by the same time, it optimizes overall profitability by encouraging a transfer price only if the company would benefit from the exchange. So we're still looking for a number that makes most sense for everybody involved. It's not an easy deal. Looking at the top picture, you have the selling division wants a higher price possible to maximize its division revenue. And then you have the transfer price, whatever it may be, or is what's determined. And then you have the buying division, and it wants a low price to maximize its division's cost. So it's exactly what I mentioned earlier, is you have competing priorities here. And if we look at the first bullet point here, optimize overall profitability by encouraging a transfer price only if the company would benefit from the exchange. And then vertical integration a new concept here that's really sometimes introduced when you have these kind of competing priority is the purchasing other companies within one supply chain to maximize profits. Let's see if it actually, I don't know why it dropped in this concept of vertical integration right now, but let's see if I can find something online. Let's go with what I know that all of you have heard of, and that's Ford automobiles. The supply chain is tires, steel, and they come to Ford automotive manufacturing. What vertical integration is that Ford decides, you know what, I want to take control of steel manufacturing. They're going to essentially take it over. They buy it out. So now we're moving down the supply chain so that we have greater control. Maybe this steel plant sells to other auto manufacturers. Well, if Ford buys it all out, it's gone. Now it becomes a division of Ford. They may or may not continue to sell to others, but at least Ford has total control over the steel manufacturer. And then the same thing would be hold true if Ford decided to own or purchase a tire manufacturer. They would buy it out, and now they have total control of that process. That would be considered vertical integration. Now, again, I don't really quite understand why they're introducing that concept in this area, but let's go with it. So vertical integration, purchasing other companies within one's supply chain to maximize profits. Got it now? Okay. Okay, now let's get back to transfer prices. So there are different strategies to determine which one will work best or which one people would like to use. You have your market strategy or your market price, and that would mean that the divisions would negotiate based upon if there's a market of that product somewhere else. If somebody else sells that product or service outside of the organization, then you could find the market price. And so the advantages to using the market price is it's usually viewed as fair to both parties. Well, we know what the market price is. We can look it up. The disadvantages is can only be used if an outside market exists. Well, that's what I mentioned to you. You'd have to find out if that market truly exists, and if it doesn't, then you're going to have to throw this market price out. It may not exist. It may be just a department that is in every organization. So the considerations we want when we're talking about the market price is the market price could be reduced by any cost savings occurred from the internal sale, for example, marketing costs. The next strategy could be the negotiated price. And if you're going to use this strategy, you're going to allow the division managers to negotiate it between the two of them, see if they can come up with an agreement. And that becomes the price that is agreed upon by both parties. The disadvantage to that is it takes time and effort, may lead to friction or even a better understanding. Sometimes friction can actually lead after discussion and say, oh, okay, that makes sense. But that could be a disadvantage where you have like a competing priority, so there's friction between the division managers. And then the consideration when you're looking at negotiated pricing, the negotiated transfer price will generally fall in the range between variable costs on the low end and the market price on the high end. And then the last strategy would be called a cost or cost plus markup. And the advantages is it's useful if a market price is not available. So if there's nowhere else for us to go to see, maybe this is always a division within other organizations. Oops. Maybe this is a division within other organizations, so there's no way we can actually find a market price. The disadvantage is the selling division has no incentive to control costs. A fair markup may be difficult to determine. So the selling division says, okay, well, whatever it costs me, that's what you have to pay. And there's really no incentive to save costs now because they don't have to worry about making money because it is what it is. Whatever it costs them, they're good to go. So that becomes a bit of a problem for the buying division. Several considerations is that several definitions of cost could be used. They range from variable cost to full absorption costing. Another thing we have to take into consideration is global considerations. We'll consider global considerations. How's that? that works. Do the divisions operate under different taxing authorities, such as that income tax rates are higher for one division than the other? Well, that would be something we need to be taken into consideration, but particularly if we're trying to transfer prices. And would the amount paid for customs and duties be impacted by the transfer price? Well, if you're working from a global perspective, there may be some customs and duties that have to be paid when you're transferring products from one country to another country. That definitely has to be taken into consideration for the transfer price.